Amazon has underperformed the S&P 500 index in 2025, rising only 6% year to date. So investors are looking ahead to 2026 and they're asking me, what do I think about Amazon stock for 2026? Is it a buy, hold, or sell? I'll answer that question in this video, looking at the company's longer-term history in revenue growth, in cash flow, in returns on invested capital, and then looking at the valuation to determine if it's attractive at current market prices.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Amazon has done a phenomenal job increasing revenue over the previous decade. From $107 billion in 2015, it's increased its revenue by more than 6x to $691 billion in the most recent trailing 12-month period. Now, the good news for investors is that the company's faster growing segments are the segments that are more profitable. Those include its web services segment, AWS, and a part where it's not reported in a segment separately, but its advertising business is growing robustly, and that's another high margin segment for Amazon looking forward. So returns on invested capital are going to be a much more important metric for these large tech hyperscalers that are spending hundreds of billions of dollars in developing the data centers for artificial intelligence. You want to measure their returns on invested capital to see if they're allocating this capital effectively. Now, one thing that's been interesting, and you may have seen this for my channel members that watched the collaboration between myself and Dimitri, we took a deep dive into the financial statements of Amazon. And in that financial statement, Amazon disclosed that the bulk of the capital expenditures is going for its Amazon Web Services segment and not the e-commerce segment. And the better part of the previous decade, most of its capital expenditure had gone to that e-commerce segment, the fulfillment, the logistics, the warehouses, the automation, the robotics, the planes, the trucks, the vans. All of that took a lot of capital expenditure to build out. And the reason why it's important right now is what I mentioned earlier, that the AWS segment is a lot more profitable. And so it's reasonable to assume that going forward, Amazon's return on invested capital will be significantly higher than looking backward, because where it's investing its capital right now, it's in its higher margin segment. And already, if you look at the previous decade, it's done a good job improving the return on invested capital from 7.1% in 2016 to 12.5% most recently. And I expect, and I think it's reasonable to assume that this will increase because of what I mentioned earlier. It's spending in a category that's likely to generate much higher margins than previous averages indicate. The next thing I wanted to evaluate is the company's cash flow from operations to sales. And I love the trend that Amazon demonstrates here, increasing from 7.4% in 2013 up to 18.9% in the most recent trailing 12-month period. Now, for the same reason I mentioned with the return on invested capital, I expect this ratio will continue increasing because the company is investing in the more lucrative part of its business, which generates better cash flow per dollar generated in sales. So now let's look at valuation. And by the way, I'm getting all these charts from fiscal.ai. They're my preferred data provider. There's a link in the description where you can get a 15% discount on their services. I recommend the annual subscription because you save a lot more by choosing the annual instead of the monthly subscription. So looking at Amazon's forward price to earnings ratio, it's trading near the lower end of where it's traded for according to this metric going back all the way to early 2024. It's trading at a forward PE of 31.5, which I think is an attractive price for a company with its performance history and with the tailwinds it's facing looking forward. People are likely to spend more money online compared to in person, and that's right in the wheelhouse of Amazon where it will benefit. Furthermore, its investments in artificial intelligence are already starting to pay off, and we're seeing an acceleration in its AWS segment. So you've seen a company with excellent revenue growth, improving margins, improving cash flow. It all points to positive prospects in the future. Of course, there is one significant headwind, and that's the tariffs that the company faces. A large percentage of its products that are sold in the United States are imported from outside the United States. So nearly all of those products will face higher prices. And if the sellers on the platform choose to increase prices, that's likely to cause decreasing purchasing activity. So that's the headwind going into 2026. But I think the tailwinds are far larger than the headwinds for Amazon in 2026. Now, looking at the valuation using my proprietary discounted cash flow model, I get a similar outcome, which is that the stock looks undervalued. The current market price is 232. The intrinsic value per share I calculated is 273. So all that being said, what do I think about Amazon stock for 2026? Well, actually, I think it's one of the best stocks you can buy, and I have it rated as such. And I recently bought Amazon stock for my own portfolio because I thought it such an undervaluation and such a good opportunity for investing in long term. Hey, if you value my process for researching stocks, I think you'll appreciate access to my spreadsheet containing my discounted cash flow valuations, which calculate a fair value for over 200 companies. It answers the question, what's a good price to pay for a certain stock? You can get access by joining our channel at the investor tier or above. See the link in the description or click the join button below to learn more.